Hi, I'm Kevin Castaneda, and this is Kevin's Mindset, where we talk everything finance, investing, mindset, and productivity. And today we're going to be talking about how you can create a long-term portfolio, how you can allocate certain funds, and how you can set it up in order for it to fit your standards and your prospects for growth. So if you do enjoy this video, go ahead and smash that like button, as I would very much appreciate it, and helps push out this video on the YouTube algorithm. Also, go ahead and subscribe if you do want to watch more of my content in the future, because you definitely will. Also, go ahead and sign up with Public down below if you want to get up to $70 of stock of your choice just for signing up. So now let's hop straight into the video. So recently I've kind of been in like a stump where I went through this whole kind of learning phase in my first year of investing back in 2020. And I kind of went through this phase where I'm like, okay, I want to put everything into one stock so it flies up and I make as much money on that one stock. Then I realized how risky that was, and I didn't do enough due diligence back then or anything like that. Then I moved on to trading and so on and so forth. I went through many different strategies. Now I'm finally at a point where I think that the strategy that I want to implement, the strategy I have been implementing, is actually a valid strategy. And investors like Ross Lynch and Warren Buffett, Charlie Munger, they all follow this, and they've all kind of talked about this for a long time. Now, we all know that Warren Buffett generally says, just buy the S&P 500 and wait it out for a long time if you were a normal, common person. However, personally, I do like picking stocks. I do like going and read those 10K forums and running valuations and all this. It's a passion of mine. So I definitely am not a fan of just going and buying VTI and VOO and letting it go on for 20-30 years and hoping that I made a good amount. I know that's definitely a foolproof plan, but I do rather just creating a portfolio of stocks and brands that I think will do great in the long term. So what am I doing, and how am I setting up my portfolio for long-term growth that will prosper for a long time? Now, I'm breaking this into a 50-50 split. Now, the way I'm doing this is I picked 5 companies that are big caps that I love, like 5 companies that I think are going to be around for a long time, that I think are huge companies with huge growth potential, and that I think that they are definitely like a huge brand and huge value to it. So these 5 companies for me are Tesla, Apple, Google, Amazon, Facebook, basically big tech. And I think that these all have their own kind of potential within them. I think Tesla with AI, with their cars, with autonomy, with all these things, with solar, with all the new advances that they're making, I think Tesla is definitely a awesome stock that I would love to own for life. Apple. Now, Apple is definitely interesting. They sell iPhones. They're a huge brand. They have hundreds of billions of dollars in cash. I think that this is a company and a brand especially that I would like to own forever. Google, I love. I stayed away from Google for so long because they weren't making money. Then when they started making money, they rallied. I didn't think that their valuation was justified. And you know what? It is what it is. I kind of missed out on Google a little bit, but I'm happy that I got some Google now, and we'll see what happens in the future. I think that they're a great SaaS company, and I think that they're going to continue to grow. Everyone uses Google. Everyone continues to use Google and YouTube as well. You're literally watching this right now on YouTube. That's insane. Facebook, I think has huge prospects for growth, with Mark Zuckerberg always wanting to innovate and wanting to make the metaverse. I think that's a huge thing for them, and I think that will push them in the right direction going forward and allow them to really create a staple for their business where people will need and love the social aspect to a new degree, where it's so realistic that they're just like, wow, this is incredible. Now, for the 5th one, Amazon, obviously. And Amazon, love the company. I think they make around $100 billion per quarter, obviously varying $5 to $15 billion per quarter, but I think they're definitely an incredible company. Now, I know that they had the rally because of the pandemic in 2020, and I think that, yeah, maybe they won't have crazy strong growth forever and ever and ever, but I think that even if they solidify the growth that they have now, and they continue pushing up margins, they continue making and flowing into money, they're going to continue to be a huge company. They're going to continue to innovate, and I love them for life. Now, with the 50-50 split, I go with those 5 long-term, super crazy growth. I think that they're insane companies, and they're going to be huge monsters for the rest of the future. Now, with that, I have 5 companies that I personally done a lot of kind of digging into. I think that there's a lot of growth prospects there, but they're not as big capped, and I don't know if they're going to be around forever. And there's definitely more risk here, but there's also more potential growth here, as they're not such mature and such huge companies yet. So with that, company number one, Enphase. Enphase is not a huge market cap, not a small market cap. It's in the tens of billions of dollars, and I think it's like $40 billion. It's in the deck of billions. So I think that Enphase definitely has a lot of prospects for growth. I think that by developing microinverters and all this, I think that they will continue to push out growth. And yeah, they might be a riskier play, and yeah, they are higher PE, but I think that there's definitely a lot of growth there. Lucid Motors. Lucid Motors is a stock I've loved forever. I had too much allocated at first because I have a lot of hope in it. But now that I'm kind of strategizing a little more with my portfolio, I think that 10% of my portfolio would be perfectly adequate for me to have in that company. And I think that there's a lot of growth coming. However, I do understand a lot of risks that they may have to overcome. And that's why they are only one of 10 of my companies in total. Now, number 3, we have Tattooed Chef. If any of you watch Jeremy Lefebvre, I'm sorry, I kind of butchered his last name. But if any of you watch Jeremy from Financial Education, he is definitely a big spokesman for Tattooed Chef. At first, I kind of stayed away. I thought it was too high valuation. Then as it came down after earnings, I finally started to do some digging. I bought in, and because I bought in, I started to do more and more digging, and I started learning more and more about the company. It's a great company. They have great prospects for growth. I think that they will hit these numbers, and I think that the industry that they were attacking is a growing industry that will continue to evolve over time. Next, this is not exactly a stock, but it is portfolio allocation. I have about 10% of my portfolio allocated towards crypto or crypto related assets. So I have about, it's like 6-7% in Coinbase, and then I have 3.5% of my portfolio in crypto as a whole. So with that, we're down to our last stock, which is AT&T. And AT&T was most traditionally a dividend stock, and they still currently at this moment are. However, they are planning to merge with Discovery Plus, and with that, they're planning to cut the dividend in half to around 3.5%. And I think that a lot of people are overreacting about that. I think 3.5% is still a great dividend, and it allows them to have new prospects for growth because it allows them to enter the entertainment industry way larger than they were before. The online streaming services are insane. Netflix has crazy valuation on it. Disney has a crazy valuation on it. And I feel like, and Discovery and AT&T are kind of getting left behind. And AT&T has like a 7 forward PE, and Discovery has one of the low 10s. It's insane. Their PEs are ridiculously low. And I think with that, it allows them to have a large market to attack and a large value, and have prospects for growth to get a huge valuation in the future. And I think that I'm kind of writing about 10% of my portfolio, betting that I think AT&T will have a good merger, and I think AT&T will continue to grow, and the market will realize its true potential with HBO Max, with Warner Brothers, with Discovery Plus, and all the kind of trademarks and stuff that they have. So with that, that sums up my 50-50 split. That sums up why I'm changing it like this. I think that if you allocate too many stocks, that you're not going to get the growth that you want. And I think it's like Warren Buffett said, why would you put more money in your 27th best idea when you could just funnel more money in your best idea? So these are my 10 best stocks. I think these five are stocks that I love. I think that the big techs and stuff are going to grow for a long time, and I think that there's still a lot of growth left to be had there. Now, with these other 5 stocks, I think that they're smaller caps. I think there's a little higher risk. However, I believe in these companies. I believe in their fundamentals, and I think that they can grow a lot in the long term. So with that, I'm leaving it off here. Smash that like button if you did enjoy this video. Go ahead and subscribe if you want to watch more of my content in the future. And don't forget to sign up with Public down below. You get up to $70 of stock of your choice just for signing up. So see you in the next one. This was Kev's Mindset.